And the millennials are that generation. So when we think about it, these are the official definitions of the different generations. There's the silent, the boomers, Gen X, millennials, Gen Z. I kind of make it simpler and just go in 20-year blocks. If you're born between 1920 and 1940, you're silent. 40 to 60, you're a baby boomer. 60 to 80, you're Gen X. 80 to 2000 is what I would define as the millennials. And then 2000 to 2020 are Gen Z. I have kids that are all born, well, actually, no, they're all Gen Z. If you're born after 2020, I don't know what the heck we call you, because Z is the last letter, so maybe that's the last generation. The first thing to know about millennials is that they are larger than the baby boomers. The baby boomers at their peak were 77 million people. Millennials are 92 million people. So it's not just kind of bigger, it's a ton bigger. And if you take the two generations and you look at boomers plus Gen Z, plus Gen X versus millennial plus Gen Z, you're something like 30 million people bigger. There's 150 million in boomers plus Gen X, something like 180 million people in millennials plus Gen Z. That's really important because of this chart. So this is the demographic profile of the United States. You'll see that the average age is a couple of years old. So the average age right now is about 30. The average American is 30 years old. Why is that important? Because no other major economy in the world looks like this. If you were to show this chart for Europe, it would look like an upside down triangle. If you showed this chart for Japan, it looks like an upside down triangle. If you showed this chart for China, it looks like an upside down triangle. It's a demographic death spiral. And the problem with that is that you've got a whole bunch of old people, relatively low number of working age people, and even fewer children coming. That means you have too much of everything. You have too many stores, you have too many schools, you have too many buildings, you have too many houses. That's an excess capacity problem. It's deflationary. It's a demographic death spiral. This is what Elon Musk talks about when he talks about the world running out of people. We don't look like that. Here's your baby boomers, great, but there's the millennials. That means we don't have enough of anything. We're 16 million homes short in this country right now for single family homes. The only two things we have too much of are stores and politicians, and we're fixing the store problem. All right. The millennial generation is also the least white generation in history. Gen Z will surpass it, but they don't matter yet because they don't make any money. Some people would say the millennials don't either, but that's another story. So what you'll see here is if you look at the baby boomers and you look at the peak birth year, there were roughly 4.5 million births, of which 3 to 3.5 million were white. In the millennial generation, you got to that same 4.5 million births, but roughly only 2.5 million were white. So this is a more racially diverse generation than anything we've seen up until now. So when you think about a millennial, you think of this guy. You think about a mustachioed man in very tight pants and checkered shirts, and he's serving IPAs in Brooklyn. But you can't. This is actually what you need to think about when you think about a millennial. More likely than not, it is a woman. She's roughly 30 years old. It may not be clear what her racial makeup is, right? That really is the face of the generation when you dig into it, at least from a money perspective. And here's why. So the millennials are the most educated generation in history. Almost 40% of millennials have a college or bachelor's degree or higher. Well, the reason for that is women. Women represent 61% of all associate's degrees in the millennial generation, 57% of all bachelor's degrees, 58% of all master's degrees, and 53% of doctor's degrees. It is an absolute objective fact that a millennial woman is the single most educated human being to ever walk the face of the earth. No generation or group of people have ever been more likely to have a college degree or higher than a millennial woman.
You like smiles that you get?
Well, it's kind of cool to be able to say something is the most of anything. And I think it is cool. I mean, I think it's cool. And what it means is that they play a different role financially than women in prior generations, which we're going to get into in a second. Now, here's the bad news for the millennial women. You will very quickly be surpassed by Gen Z. Generation Z woman will be even more educated. But for the time being, the crown goes to the millennial woman. And so here's the other bad news. Because of that fact, student loan debt is absolutely a women's issue. Women hold 2/3 of all student loan debt. I had no idea before we did this. And so when you think about student loans, the reason why is most student loan debt is graduate loan debt. And women are getting the bulk of the graduate degrees. And I'll admit this, in my house, I have a bachelor's and a CFA. My wife has a master's. So she will remind me about this chart on a regular basis, that she is, in fact, not only the most educated woman in the history of the world, but she's the most educated person in our house. Women became the majority of the workforce somewhere around 1980. But in 2019, for the first time, women also became the majority of the college-educated workforce. And that matters because once a woman gets a bachelor's degree or higher, her income rises 87%, her median income. So you have a generation of women that are making money that their moms and their grandmothers really never achieved. And there is a wage gap. Now, you can get into all the politics of the wage gap. Most of it at this point is explained by differences in professions. If you look within a profession, in most industries, a male and a female with the same amount of experience in the same role are getting paid the same amount of money. But there tends to be maybe more male engineers and maybe more female teachers. And teachers generally make a little less than engineers. But even with that, while women in general are making 85 cents on the dollar versus men, in the millennial generation, it's more like 90 cents on the dollar. So it is better in this generation than it is in prior. Since 1970, and this data doesn't include the pandemic, the most recent years, but the story is still the same. Between 1980 and 2019, men's wages went nowhere. They were up only 2%, only because they were up 2% in 2019, right? They had been flat for roughly 30 years. And if you think about this, this makes sense. Think about what a factory worker was making and how those wages have been kind of stagnant. Women's wages, on the other hand, rose 38.5%. So yes, there's still a gap, but women are making it up. Now, I think there's some stats that basically say to close the gap, this needs to continue for like another 1,000 years or something like that. So we're getting there, but we're not there. Because of that, women adult better than men in the millennial generation. So if you look at any major milestone, a woman is more likely to achieve it before her male counterpart in this generation. Again, that's never happened before. So a millennial woman is more likely to have a job than a man. She's more likely to have moved out of her parents' home than a man. She's more likely to have bought a house than a man. I mean, I can go through all of the different pieces here. Paid off her loans, built investment savings, has her own insurance coverage. She is growing up faster than her male counterparts. On a number of measures. And this chart, if there's one that's important, this is the most important chart, I think, in the presentation, or one of the most important charts. And I'll focus you on the top. In a millennial household, the woman will enter the relationship with the most or an equal amount of assets 50% of the time. She will be the primary or co-equal income earner in 2/3 of those households. She will be the primary or co-equal financial decision maker in 62% of the households, and she will be the primary or co-equal investment decision maker in 55% of the households. She matters in these households in a way, look at, these are the kind of baby boomers. She was not the primary anything in terms of in the financial world in these relationships. She is a prime driver in a way that she hasn't been before. She's more likely, and the dark blue line are millennial women, the light blue bars are baby boomer women. She's more likely than mom or grandmom to run the day-to-day banking, to do financial planning, right? Think about this business and there. Estate planning, legacy planning, charitable giving. All right, the last bar is nonsense. It says that millennial women are in charge of household purchases in 54% of the time. In my household, my wife controls 100% of all household purchases. So I don't know who is coming up with this data, but that's nonsense. I don't get to decide anything. I don't even get to choose a color. But importantly, financial planning and charitable giving. Those are the two I want you to focus on because it's going to come up again in a minute in a big way. So let's think about the life cycle of a millennial woman. She was the first generation of girl who was more likely than a boy to raise her hand in class. And everything I'm about to say here is not like my opinion. This is what the data shows. She, on average, achieved better grades than her male counterparts. She was more likely than her male counterparts to get a bachelor's degree or higher. So she left school with a ton of student debt. Like every other good millennial, she moved back in with her parents and mooched off of them until she could repair their balance sheet after taking on all that debt. She very likely entered a male-dominated workplace, because most are. She's now in her late 30s, maybe she's even in her early 40s. I'm the world's oldest living millennial, and I'm 40. She's had a successful career. She's earned some money. And now what? I'll tell you what she doesn't want. She doesn't want somebody to say, all right, let me tell you what to do now. Like, you weren't with her through this, and you weren't with her through that, and you weren't with her through that. And so she doesn't want to be told what to do. She wants you to say something like, okay, you're crushing it. How can I help? All the research that we've done suggests that she doesn't necessarily care if she hears that message from a man or a woman. It doesn't necessarily matter to her. It's nice if when she walks into an office, it's not all men. That comes across in the data. She wants to see some people that are like her. But she's just as willing to take that advice from a male as she is from a female, as long as it's collaborative. She doesn't want to be condescended to. And that came across in all the research that we did. This one is shocking to me. Well, not shocking to me, because I know me and I know my wife. So if you ask women, how knowledgeable are you about investing? Only 19% will say that they're very knowledgeable. If you ask men that question, all but 13% say either somewhat or very. Okay, this is where this gets fun. They're both wrong. Women on average trade 45% less and beat their male counterparts by 100 basis points, 1% of alpha per year, because they trade less. And I think one of the reasons why is, and we're going to get to this in a second, men tend to think about investment returns in a comparative way. My return was bigger than your return last year. I did better than the market. Women, in the research that we found, don't think that way. They ask themselves, did what happened in the market this year make it more or less likely that I'm going to achieve my long-term goals? And because of that, they trade less. They tend to focus with a longer-term time horizon. And we'll get to one of the motivators of that in a second. The other thing here is millennials start life later. So you hear a lot of talk about millennials are very different from their parents. Here's a secret. I have never made one independent financial decision in my life. I do exactly what my wife tells me when she tells me to do it. And I'm joking, but what I mean by that is, look at the early boomers and look at first childbirth. Early boomers were likely to have their first child at 21. A millennial is likely to have their first child at 32. Why does that matter? Because if I didn't have kids, I wouldn't live in a suburban home. I would live in an apartment. Even at my age, I would live in an apartment, right? I wouldn't drive a 7-passenger vehicle. I would drive something much smaller. You don't make a life decision because you hit 25. You make a life decision because you have a family or you don't, or you have a spouse or you don't, or you have a child or you don't. And so what happens is what a lot of the studies will do is they'll look at a 25-year-old millennial and compare them to a 25-year-old boomer. Well, by the time the boomer was 25, they had a 4-year-old at home. When the millennial was 25, they're not going to have a kid for 7 years. So you can't compare that. What you have to look at is, what does a 21-year-old, what does a 32-year-old millennial look like compared to a 21-year-old boomer? And when you look at it that way, they're not all that different. The behaviors become much more similar. The investing patterns, the saving patterns, the estate planning patterns, the propensity to live in a single-family home become more similar. It is our children that age us, folks, not just the age. That's what makes us kind of grow up. And so, yes, the generation's different, but it's because of when they start their life. Well, why does that happen? Why do we start earlier or later, rather? It's because our women are more educated, right? If you're going to go to college and then you're going to go to graduate school and then you're going to get a PhD, you're probably not starting your family at 21. You're probably starting it at 32. And that's much more commonly the case in this generation than in prior. That's not necessarily a bad thing.
I think it's so important to emphasize this is the first generation in history that's true.
Yes, that's absolutely right. Ever. So what happens is when millennials are young, think about it. They've gone to school. They've got all this debt, right? You layered on $150,000 of student loan debt. The last thing that you generally want to do then is go buy a car for $60,000, buy a wedding ring for 30 grand or whatever the heck they cost. You don't want to lay on more debt. So what they do is when millennials start, they invest and they save like they're 85-year-old people ready to die because they don't want to layer on more debt. So they save for the vacation. They save for home improvement. They save for the down payment. They save for their own weddings. In other words, they invest very conservatively because all of their goals are short term. It doesn't make sense to not pay off a debt in order to invest, right? Think about it. Student loan debt's a 6.5% rate on most federal student loan debt. You got to make 7% on an investment to make sense to invest rather than pay off that debt. So they don't want to layer more on, and they tend to be very conservative early on. I'm going to skip this one. But 1 in 6 millennials has $100,000 in liquid assets or more. And once they turn 30, something magical happens. They get really aggressive. Why? So I have 3 children. If anybody wants one. When you have the baby and you're in the hospital, they give you 3 things, right? They give you the baby, which you have no idea what to do with. They give you the bill for having this baby. And that comes along with an 18-year investment horizon because you got to figure out how you're going to send this kid to college. And so what happens is a millennial, once they turn 30 and they start their families, all of a sudden they get much more aggressive on their investing because they've started to take care of some of those short-term goals. They've saved for that down payment. They've saved for the ring. They've saved for the car. They've saved the emergency fund. And now they've got an 18-year investment horizon and they need to send these kids to school. So all of a sudden they get very aggressive with their investing, which makes sense. That would happen with a baby boomer earlier, but it happens with millennials a little bit later. The other thing that we have, so we are disadvantaged as a generation in a lot of ways. We will never see a pension. I don't even know how to spell pension. I can't even imagine having a pension. But you know what we do have? We've got really rich parents. And they've got $30 trillion in wealth that will be primarily transferred to the millennial generation. So, you were talking earlier about how the Cooke Group talks to children. You have to talk to daughters. I'll give you a personal example in my own experience. So, my wife's family, her father worked for a small heating and air conditioning company. They paid him with an ESOP. They sold the company. All of a sudden, he has some assets. My daughter will be a prime benefit. My wife, his daughter, will be a prime beneficiary of that. I only know one thing. We won't keep the money with his advisor. And the reason I know that is because I don't know his advisor's name. We've never met him. We've never talked to him. This person needed to make like 3 phone calls. When she graduated college, you graduated college, you have some debt. What can we do to work that down? And then when we had each of our 3 children, so I guess that's 4 phone calls, let's talk about a 529. And this guy would have kept every dime of that money for the rest, I'm assuming it's a guy, for the rest of his career. But he didn't, and we don't know him. So guess who isn't going to keep that money? This matters because when money changes generational hands, it tends to leave the firm 70 to 80% of the time, unless that firm talks to daughters and sons. And it's primarily daughters because they're going to inherit more. Yeah.
If I can say, how many firms like the Cooke Financial Group are doing this?
This will be the first that I do this year. I mean, I've given this presentation before, but not in this kind of setting to younger folks. And I think it's incredibly important. We're going to there's data that supports this. Here's something that's really cool. Not cool, weird. Survey question, are you primarily concerned in retirement about your health or your wealth? For men, it was a kind of split, 54% health, 46% wealth. For women, it was 70% wealth and only 30% health. In fact, of any financial concern that we could survey on, the primary insecurity of female millennial investors was running out of money when they got older. I was shocked by that. I thought it would have been student loans. I thought it would have been emergency funds. It was retirement savings. And when you dig into it, it kind of makes sense. One, women live longer than men, mostly because we do really stupid things that make us die. Like we jump off of weird things and we start fights that we're not supposed to. And we do all kinds of dumb things. Exactly, right? We fast cars and dumb decisions, right? But women live longer. They also tend to start investing later. And there's a wage gap. They make less. So if you make less, you start investing later and you live longer, the odds of you running out of money are in fact higher. And for better or worse, traditionally, parents have taught their daughters to save and their sons to invest. So what you see is there's a lot of times a reticence for younger females to take that money that's in their savings and invest it. They want it in that cash. They want to believe that it's there. They want to be able to draw on it. And they don't always recognize, well, you can sell the investment if you need it, let it grow. And so if you start later, this is kind of a fear that is actually quite rational. It's also why scenario testing is so important for this generation. Like think about it this way. Here's two different ways of talking about risk. Imagine that I come to you and I say, you need to take more risk in your portfolio in order to get a higher return. A lot of people, both men and women, but more women than men, would say, yeah, I don't like that idea. I don't like that whole idea of taking risk, right? Now, what if I framed it to you this way? If you keep your current strategy, the chances of you running out of money are 30%. But if you buy more equities, the chances of you running out of money will drop to 4%. Well, that's a different discussion altogether, right? And you see that a lot. It's the long-term goals. If the market's down 20%, people will be worried. But if you can say to them, the market was down 20% this year, but your odds of achieving your financial goals went from 99.9% to 99.8%, all right, I don't care. Let's keep going. The Monte Carlo scenario testing is very important for this generation. Millennials are actually good retirement savers, and that makes sense given that insecurity. In addition, this is kind of interesting. Retirement education and education on financial planning and investing is really important for this generation because if you've been to a school, they teach you all kinds of stuff you don't want to know. Like I'd like to know about like how to balance my checkbook and, well, nobody has a checkbook anymore, but how to manage my finances or how to save for retirement, and they teach us geometry. I don't give a darn about geometry. But what you'll find out is particularly women are more likely than males to say that they want education on managing expenses, or they want education on figuring out how much you need for retirement, 65%, getting 401k advice. Remember, this is a prime concern for this group of folks. In addition, it's the same things that everybody always cares about. Do I have a good personal relationship with my advisor? Are fees reasonable? What kind of services are provided? They're no different than anybody else. This one is interesting. And I think this also talks to the value of Cooke in an important way. Millennials in general, female millennials more specifically, do not trust big brands, right? If you think about our generation, we have been abandoned and disappointed by every major institution in the world, right? Everything that was supposed to be great has really not been that great, whether it's the government or big business. Like we've seen everybody scandalized in our short period of life. And so I have no interest in what commercial bank you're with or what private bank, because you know what? I've been ignored by every major institution in the world anyway. What I want to know is I trust my family office executive, my accountant, my financial advisor, the person that I know. That's who I'm interested in, not the firm that they're with. And it's important, and I think this is what we're doing here today, is to communicate as a financial professional to younger people that my value set or your value set is compatible with theirs. And we're going to get to why that's really important in a second. In addition, we just talked about how female millennials talk so much or are so concerned about their retirement savings, right? And running out of money in retirement. Yet, only, what's the one? It's here somewhere. Only 35% of millennial women report talking to their advisor quarterly about retirement. It's their single biggest concern, and 65% of them never talk to their advisor about it. A couple of other things. they don't get the support they need. So light blue line is women, dark blue line is men. Women are more likely than male to use a dedicated advisor. Interesting. They are less likely to use a trusted advisor. We don't need to talk about that here. Less likely to talk to their advisor about new ideas quarterly, less likely to talk to their advisors about retirement planning quarterly, and therefore are, wouldn't you be surprised, less satisfied with the service from their advisors. There's I don't know if you've seen these memes or these jokes, but it's like an old-fashioned man next to an old-fashioned woman, and the man will say, women are these mysterious creatures. It's hard to understand what it is they want. And the woman will say, well, if you just listen, I'll explain to you. Like, it's impossible to figure out what these people want. And that's kind of the relationship that's going on here. Tools and services are important. You know, we're talking about this setup here, right? Think about how many people wanted to access this discussion tonight virtually, right? They either couldn't or didn't want to or didn't have the capacity to come in. And so we're meeting them where they are. Yeah. Well, look, they're asking for things like access to a dedicated advisor, but they want comparisons between active and passive, and they want self-directed investment portals where they can go in and learn about what's going on in their accounts, and they want access to information. This one I think is really cool. Millennials, prior generations. Millennials want a self-directed investment portal. Remember, these are folks that are generally insecure about their investing knowledge, so they don't necessarily want to sit down and say, hey, here's all the things I don't know. And when you talk about, I'm confused by. But if you have a self-directed investment portal that I can go to and I can take a class on retirement planning, or I can read an article, well, it allows me to learn without being embarrassed about not knowing. And so millennials want that. Gamification. I'll tell you a story. I was doing a presentation, not unlike this, in a room of, let's say, 250 people. To be in the room, you had to have $100 million invested with that firm. Okay. And they had iPads on all the tables, and I was speaking, and there were things where I would ask a question and people had to answer on their iPad. And if you answered, you got a point. And if you got the most points, you won an umbrella. Everyone in the room had to have $100 million invested with this firm. They would have stabbed each other for the umbrella, right? Gamification. If I go on that website and I fill out a paperwork, or I read an article, or I take a training class, give me a point, I get 5 points, I get a sandwich or an umbrella or something. You can think it's crazy or not, millennials want it. When we go to Starbucks, we get a point, we get a free coffee. When I go to my investment manager, I want my darn free coffee. Mobile platforms, they want to be able to access their investment information on whatever devices in their pocket. Social media and sentiment indicators. People want to know what other people like them are buying. So if I'm going to be investing a certain way, I want to know, are other people my age investing that way? How are people thinking about things? Financial tracking data. This is interesting. So women in particular, and millennials in particular, are much more interested in the impact of their investments on the world, right? Whether it's environmental, social, whatever the case is. And this has become a kind of bad word in the investing world over the last year. This is not a political thing. What you're going to find, and what we're going to get into is there's a very logical reason why female millennials in particular tend to think about the kind of brands they do business with, whether it's from an investing or a purchasing perspective. And I'm going to build the case. Skip this one. So the gray line is men. The dark blue in the middle is older women. The light blue are millennial women. Millennial women are more likely to want to align their spending with important causes. They're more likely to try to tackle societal issues through investing, 76%. View impact investing as a form of giving, 70%. Align investment goals with giving goals, 39%. Why? Well, let's think about this. The normal life cycle in this country is you go to work for whatever company will hire you, earning as much money as you possibly can. You then buy whatever goods you need without ever thinking about who makes them or why or where. You invest it in whatever companies will make you the most money. And then when you retire, you do something good with it. You give it away and you save the world. You either give it to the Puppy Foundation or you give it to Feed the Hungry, right? You engage in a charitable activity towards the end of your life, having reached your goals. Millennial women don't think they're going to have enough money. Their primary concern is running out of money in retirement. So they don't think that they're necessarily going to have this big bundle of money to give away. And so you've got to work yourself backwards. I want to make sure that I'm buying goods from companies that represent my value set. Want proof on this one? Remember when Lululemon had certain women of a certain size shouldn't buy my pants? And what happened to that stock for 3 years, right? Tackle societal issues through investing. I can't give it away to change the world, but I can choose what companies I fund by buying certain stocks and avoiding other stocks. Again, view impact investing as a form of giving. I don't expect to have the money to give, so my investing is a form of charity. No other generation has ever seen it that way. This is a completely new mindset. You can like this, you can dislike this, this can make you happy, it can make you unhappy. That's entirely a you problem. This is what they're telling us. And so they want to align their investing with their giving goals because they view it as a form of giving. That is just an altogether different approach to spending and earning money, and even where you make it. A lot of millennials don't want to work for a company that they think doesn't share their value set. This is different. I know my wife is like this. My wife won't shop at certain places and she won't buy certain goods. She doesn't want to associate with it. Me and whatever's cheaper, but that's just me. And that's why you've seen a big kind of push behind these styles of investing. The other thing is, and I'm going to skip this one. When I was a kid and I did well in school, my parents would take me to the local KB toy store, which doesn't even exist anymore, and there'd be a shelf, and they'd say, pick what you'd like from the shelf. When my kids get a good grade, we pull up Amazon and choose from the entire world's inventory of everything. Millennials don't like off-the-shelf, let's skip this one, off-the-shelf solutions, right? No good self-loving millennial goes into Dunkin' Donuts and orders a black coffee, right? We go into Starbucks and we order from an unlimited assortment of various caffeinated beverages with oat milk and hemp milk and monk fruit sweetener and Java and Sumatra and whatever the heck else there is. There's an expectation of customization at a reasonable price. And so what you see is that this generation, in a way that other generations haven't, are gravitating to things like separately managed accounts, right? I want the low fees, but I want a customized experience. I don't want you to put me in a cookie cutter something from John Q. Big Firm that doesn't recognize all the wonderful specificity that is me. I want you to run my money, and I want it to reflect my interests and my values and when I'm going to retire and my goals, and then I want you to do it at a reasonable price. The millennials are not cheap, but they are value conscious. They will pay the premium price, case in point, these things, which we've made very popular, but it better be quality. It better be quality for the price. And that's different than, again, some of the prior generations. I'm going to close here. I'll wrap it up for questions, and then I'll give up the floor. All a market is in the long run, all it is in the long run, is the fundamentals of the market multiplied by the buying and selling decisions of its participants. From the beginning of time until 2015, men were the majority of folks that made decisions in the market. They owned the majority of stocks. They don't. Women own the majority of stocks now. And in the past, I want to see something.
That's an amazing chart.
It is.
The amount of blue and the tiny little stripe of red.
Well, and here's the thing about it. For years and years and years, all the investment research was about women being more conservative investors than men. And for most of history, they were. But you have to remember, how did they come into their wealth? They generally came into the wealth and the path at the death of a parent, a divorce, or the death of a spouse. That is not the millennial woman's experience. It's her money. She earned it. She's crushing it. She's a badass, right? So she doesn't have the same hang-up. She's not more conservative than her male counterparts. She's just as aggressive as they are. And so it's not only different in terms of who owns the majority of the securities, but it's the mindset of those women as they own them, because these are really theirs. They've accumulated this income. They've accumulated this wealth. They have their own goals. They're not simply taking on wealth at a moment of personal tragedy, which was the experience 40 or 50 years ago, predominantly, not exclusively, but predominantly. And so it's a different game. And I mean, I love my wife dearly. I can tell you she makes different decisions than I do. And so the decisions that are being made in the market are different. And you ignore that at your peril. So I'll kind of close it. Oh God, that's terrible. All right, we'll do that. I'll kind of close it by saying that, look, there's a real opportunity here. There's a new generation of folks that are taking on a tremendous amount of wealth. The millennial generation is not that different. It's not that weird. It's not like these are a different breed of human. They just start later. And the decisions are made more and more by women. So I think it's important that if you are someone who's on the call or you're in the room and you're thinking about the next generation of wealth in your family and who's going to take that next generation, think about how you cultivate your children in general, but also your daughters. You know, are they comfortable doing this? What education are they seeking? What are their goals? How are they going to think about managing it? If you're the folks here at Cooke, and I know the reason I'm here is because you are thinking about this, you want to think about developing those relationships and providing that education, because at the end of the day, women are going to hold the bulk of the wealth in this country in a way that they never have before. And that's a little bit of a different game. Thank you. Happy to take any questions you might have, if we have time for it. Well, I'll be going right on.
Thank you, Steve.
Right to you. There you go. Thank you.
And we are actually going to steal the microphone off of you. That's okay.
I'm not willing to give it up.
Are there two questions online there? We have no questions online. Maybe we can specify it and tell them that.
Yeah,
If
we
you've
can
got
also take
questions,
questions at
can you
the
hear me
end.
good?
Yeah.
If you've got questions, feel free to put them in the chat and we'll,
Send them in.
send them in.
Yep.
Okay.
Thanks again, Steve. That was an awesome speech. And it's really interesting to see how our generation is different from our parents' generation, how we think about wealth differently. My name is Claire Cooke, by the way. I am a wealth advisor here at Cooke Financial, and this is John Cooke.
John, good to see everybody.
He is also a wealth advisor at Cooke Financial Group and also my brother.
Yeah.
So John and I wanted to further Steve's conversation a little bit and talk about different types of retirement accounts and how best you can organize these type of accounts, where you should contribute first, where you should contribute second, so that you're maximizing your retirement accounts. So with that, let's see. So first I'll just take a step back and, there's two different types of accounts. There's a taxable account and there's a retirement account. Taxable accounts are not as tax efficient as retirement accounts. So essentially you're getting taxed when you make your income, and you're also getting taxed when that money is withdrawn on any of the gains. You're getting taxed on any of the income that those investments generate. Where retirement accounts come in is these accounts are tax advantaged. So there's two different kinds. There's a traditional IRA and there's a Roth IRA. And essentially the difference between these two is just when they get taxed. So a Roth IRA gets taxed upfront. So when you contribute funds to a Roth IRA, that money will get taxed, but all of the withdrawals in your retirement are tax-free. So all of the growth in that account, assuming it's invested, it gets to grow tax-free. You're not paying taxes on the back end. A traditional IRA, that gets, when you put your money in, that does not get taxed. So it gets taxed on the back end. So when you withdraw that money in retirement, you'll get taxed. So that's kind of the difference.
Yeah.
What we think is important for the millennial generation to understand while we're young is that a Roth IRA is generally more attractive for us, because when you're younger, your money has a longer time to grow. So if we invest when we're young, that anything that we invest in these accounts, so first you make your annual contribution, then you invest it. Anything in that account has more years to grow. And there's a compounding effect that we're going to touch on a little bit later that adds a lot of value there. The second part of that is if you expect to be in a higher tax bracket when you're older, so you expect your income generally to increase. That means that you're paying lower taxes when you're making these contributions when you're young, and you're not paying taxes when you're in a higher tax bracket when you're older and you're trying to withdraw this money. Whereas it's the opposite for a traditional IRA. You would essentially be withdrawing at a higher tax bracket in retirement.
And that's important because there's a lot of people who are going to question it. And some advisors will say the traditional may be better because a lot of people spend less in retirement. Actually, you don't have kids or a household to run. You're not commuting to work anymore, so on and so forth. But we don't know what the taxes are going to be like in the future. There's a pretty high probability that the base tax rate in the future is higher significantly than it is today. So what we're really doing is getting you some value by paying now when it's cheap, and then up front, and then later on, you're out scot-free. You've already paid your taxes, and if the taxes go up later, it's not going to affect your retirement.
So here's just a brief comparison of traditional IRAs versus Roth IRAs. So we talked a little bit about the pre and post tax, when it's funded, when it's withdrawn, when it gets taxed. Contribution limits are the same for both. So for someone our age, it would be $6,500 per year. That increases with inflation. So for example, in 2024, that'll get increased to $7,000. There's also a catch-up amount of $7,500 if you're over the age of 50. A little less relevant for us millennials. And again, we've touched on a lot of the differences here. Required minimum distribution is one other thing we haven't touched on. So with a traditional IRA, the government says, hey, we want you to pay taxes on this money that you have not paid taxes on since you invest or since you made those contributions. So they make you take out money in retirement. That's called the required minimum distribution. And that's a calculation based on your age. In a Roth IRA, there is not a required minimum distribution because you've already paid taxes on that up front. So this is really important. If you don't need that IRA money that you have saved for, you don't have to withdraw it from the account. So you don't have to pay any taxes on it, and you can save that for charity, for children. You can use it for a lot of other things.
Or on the flip side, if you have a really big withdrawal in 1 year, maybe you want to buy a house or something along the lines that it's not going to be all counted against your income. It's not going to shoot you up into the highest tax bracket. You can take that distribution and not really be as concerned about how you have to space it out and how you have to save, because in a traditional IRA, you would.
So you're probably asking, why wouldn't you just only contribute to a Roth IRA? The government does realize how efficient this investment account is, and so they do put an income limit on it. So starting at around $138,000 of income if you are single, $218,000 if you are married, they start to phase out the amount that you are allowed to contribute to a Roth IRA. So for example, if you are single and you make $144,000 a year, out of that $6,500 annual limit, you're only allowed to contribute $3,900 to your Roth IRA. So that $2,600 has to go to your traditional IRA. So you can invest in both types of accounts in the same year, but you are not allowed to contribute more than that $6,500, and you do have to follow these guidelines if you're contributing to a Roth IRA.
Absolutely. Now, there is a loophole, as there always is. So if you are over that income limit, but you're young and you maybe still want some Roth funds to build up, you can do what we commonly refer to as a backdoor Roth or a Roth conversion. So if you had an employer that only allowed traditional 401k contributions, and then you left that employer and rolled that over into your traditional IRA, but you wanted the Roth funds for the long run, you just do a conversion. And all that means is you take that pre-tax money from the traditional account and move it to the Roth account. And you tell the government, hey, I've moved it. I didn't pay taxes on this money, but now I'm moving it into the post-tax account. So I'm going to pay taxes now. And they're going to hit you with that on your income tax. So if you move $5,000, your taxable income will go up by $5,000. And if you're in the 20% tax bracket, you're going to have to pay an additional 20% on that $5,000. But you may think it's worth it up front to do that. And you really do want to build up a bit of both funds if you have the choice. Generally, this will come into play, especially if you either switch jobs or have a period where you're laid off and your income drops for a portion of the year. It can be efficient to do these conversions when you have no income because you'll be in a low tax bracket, and it actually won't cost you a lot to do this switch. So there's a lot of loopholes around this, and you want to be really efficient tax-wise, because taxes are the single biggest expense you're going to have to account for that is in your control here.
Yeah. So generally the idea is move as much money as you can into this account that can grow tax-free when you're young, when you're in the lower tax bracket.
And as for 401ks, A lot of people are familiar with 401ks. Not a lot of people are familiar that you can do a Roth 401k. If your employer offers that, you should do it. But that's not really the true benefit of the 401k. The really big advantage of the 401k is the employer match.
Yeah, the employer match essentially means that most employers who offer 401k plan will match up to a certain percent that you're contributing. So maybe that's 3%, maybe that's 6%. So if you're investing 3%, you're getting an additional 3% from your company that they are paying out of their pocket going into your account.
Mm-hmm.
This is free money. This is a great way that, even if you're not maxing out your 401k, you should at least be hitting the employer match because that's free money.
You don't get returns like that anywhere else.
Yes. And just to note, the annual contribution limit for 401k is $22,500. Next year, it'll be $23,000. It grows with inflation.
So you may be saying, all right, this is a bunch of different accounts. I'm not really sure how to prioritize, how to order them. So we've gone ahead and created a little guide for you, a little flow chart. So first off, number one, as always, is going to be build up your savings if you haven't already. You got to be able to account for a surprise car accident or maybe a down payment for a house, or maybe you lose your job for a couple months. You want that safety margin to protect you. So that's the first thing. It's not even really an investment, I would argue. It's just protecting yourself from life. But once you've done that, then what? Your next step is going to be high interest debt. So similar to the match, what's the best and most immediate return on your money that you can get guaranteed? Paying down high interest debt. If you've got credit cards and you're paying 20% interest every year on that, every dollar you put towards it saves you 20%. It's effectively like you earned 20% in the market. So that is going to be the number one thing you're going to want to do. Now, you may be saying, hey, what's high interest? How do you qualify that? Generally, anything higher, as Steve actually mentioned in his presentation, anything higher than you can earn. So right now, the risk-free rate, right, if you were to look at a short-term treasury bill, is around 5%. So anything over 5%, I want you to think of as high interest debt. If you have debt over that, it's generally going to be worth it to just pay that off, even if it means skipping some investments, because in the long run, you're going to come out ahead.
Yeah, and the next one, which we just touched on, is that employer match. So make sure you're hitting whatever that percentage is. It's different for every company, so you need to check with your 401k administrator. But generally, it's around 3 to 6%. Number 4, contribute the maximum amount to your IRAs. So that's that $6,500 number we mentioned earlier for 2023. That'll get bumped to $7,000 in 2024. If I was doing it, I would recommend, if you haven't funded that already for 2023, get that in. You can always contribute for prior year. So if you don't get around to it before Christmas, there's still time in, January, February, March.
Deadline is tax time.
Yes. And also make sure you're contributing next year as well. Make this an annual thing.
If it's easier to budget, monthly is okay as well, but you do get an advantage doing it all up front in the long run. So just something to consider.
Yeah, ideally doing it at the beginning of the year makes sense. Your money has more time to grow in the account, assuming that you're investing it once it's contributed to the IRA account. And as we touched on, ideally, if you can, invest in the Roth. If you're at that income level where, you may be phasing out of the Roth, like we touched on, you can contribute as much to the Roth as possible, invest the rest in your traditional IRA, and consider whether a Roth conversion is the right fit for you.
Absolutely. And beyond that, when you max out the rest of your 401k beyond the match, you'll be doing about $30,000 a year in retirement savings. So if we just stop right here and say you're doing 30 grand a year every year from now until retirement, let's say that's in 40 years for you. If we run that at just average market returns, even conservative market returns, you're going to be looking at about, what did we say?
I think it was
6.6 million at retirement. 30 grand a year every year at market rates. So obviously that is a flat linear calculation just with historical averages. It's going to be a little different in practice. But you need to understand the power in that everybody with a 6-figure job should be doing, or if they can, should be doing this. And you will retire with more than $6 million if assuming you can do that consistently and stick to it in the long run.
Yeah. And just to go off of that, key part here is once you contribute the funds, you need to make sure they are invested as well in order to get that kind of return.
Absolutely.
Number 6, pay down other debt. So maybe you have a 5% loan or, any other debt that maybe a car payment, things like that. If you have, a debt interest rate that's in line with the market, now would be a good time to consider paying that off. And we would argue that 6 and 7 are interchangeable depending on your, your interest rate. So maybe you have a mortgage that you got 2 years ago and it's 2 or 3%. You're always going to beat that if you're invested in the market. I shouldn't say always, but generally. And if you're earning more than you're paying, then you're winning. So in that case, we might consider leaving that debt as is and investing the rest in taxable accounts. If it's closer to the average market return, then maybe we'd consider paying down that debt before we would invest in taxable accounts.
Absolutely. Any questions?
All right. Magic of compounding. John touched on this a little bit, but essentially it just means that once you put that money in, there's growth on that money every single year. The next year, it's not looking at just your initial contribution. It's looking at your initial contribution plus your growth. That's growing. So we call it compound growing. And that's what he mentioned. If you're investing, $30,000 per year for 40 years, that becomes $6.6 million. Same idea. Even if you scale that down to $10,000 a year for 10 years, let's say you only contribute from 25 to 35 and you contribute $10,000 into your retirement accounts a year. That even turns into 1.6 million after 40 years. So it's really powerful to invest early because, for example, if you didn't invest at 25 and you invested at 35, you miss a 10-year period of doubling. That's generally how we think about it if we're assuming an average return of 7%, which is typically a historical average if you're invested in the market. If you miss that jump, that 1.6 million is only 800,000.
Yeah. Or another example, the 6.6 million goes down to 3.3.
Yeah.
10 years, waiting 10 years to begin your retirement saving costs you $3 million.
Yeah.
It's an expensive decade.
It's definitely important that if you are able to invest early.
Absolutely. And so that's pretty much it. The last bit we didn't really talk about, which is a little different one, is an HSA. It's a specific type of health plan with a high deductible that you can invest. And then at retirement age, it just becomes a traditional IRA. So you don't have to use it on medical expenses. It becomes taxed as income when you take withdrawals for non-medical. And if it's for a medical expense, it's completely tax-free. It's tax-free upfront. It's tax-free while it grows, and it's tax-free when you take it out. It's the only triple advantaged tax account that we know of. So again, that would add to the $30,000 a year. So it would depend on you and what your company offers, whether this works for you, but it's something else to consider once you're at that $30,000 per year mark.
So with that, we're going to close out. But if you have any questions, if there's any questions on the virtual Zoom, feel free to add that to the comments and we can answer that. We are also going to send out this slide deck after. So if you would like to review these slides, they're going to be available to you as well.
All right. Thanks.